right, welcome everybody to the Thursday edition of the Not Your Average Investor Show. Today we're doing the JWB Rental Property Investor of the Week. And we are talking to Mark Meisberger from California, beautiful Laguna Beach. We're going to go over a JWB property similar to ones that Mark has recently acquired, find out why Mark pivoted from single family homes from self-storage, pick his brain why he decided 10 properties wasn't going to be enough when that was his original goal, and a bunch more stuff. All right. Right now we are live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Property Investor of the Week. I am your host, Pablo Gonzalez. Today, we don't have our usual co-host GC, but we have a man who, as he just described, came from the tech industry, grew up in marketing and sales, moved to California, grew up in a real estate family, originally was going to invest mostly in storage facilities, but he got into single family homes, original goal of 10. He's going for 20. He is joining us today to break down a property just like the ones that he's recently seen and answer your questions and give you as much value as possible. Welcome, Mark Meisberger.
Hi, everybody. Thanks for having me.
It's good to have you. It's good to have you here, Mark. And I just want to welcome our Not Your Average Investor Show family to the call. If you are looking to know about and own rental property investing, you're in the right place. If you're looking to find out about the best property management practices and maybe look for somebody to do it for you in Jacksonville, you're in the right place. And if you're looking to get an edge in the Jacksonville market because you're a real estate professional and you may want some opportunities for yourself, for your clients, to partner on some deals for some new opportunities, you're in the right place. The next place to go after here is chatwithjwb.com. Pick out a time to get on with Courtney and hop on, and we will take care of you. It'll be a great value added call. And actually what we want you to do right now is we're going to be analyzing a property. So if you go to jwbinventory.com, I'll put it in the chat, jwbinventory.com, you're going to be able to download the sheet that is the property of the week. You're able to break it down and follow along at home, and you can mess with it and use it for all your own property deals. And right now, Mark, we have a little tradition that we have implemented recently, and it's the roll call. You ready for the roll call?
Sure, let's do it.
All right, we're light today, but good morning, Leo from California. Good to have you. Bill Shields with his trademarked Spanish. Buenas tardes, damas y caballeros. Buenas tardes, Bill, to you. And Bill, I hope you've been surfing out there, man. It's been good swell this week. I see we got Saori Bazuska back in the house as well. So we got Drew Barnhill. We got Gary Riley. Welcome. We got Rosalind Riley, Tim Rowe. Good to have you all back here. And hope you are here to contribute. Oh, Drew Barnhill says he did not get an email invite for this and had to do the last invite. And so did Bill Shields. That explains why we only have 10 on the call. We normally have 40 to 60 on the call. So something must have misfired in our automated system, but I'm glad the family made it. And Mark, we're going to make the best of our time here together to download your knowledge and expertise in this world of rental property investing. So why don't we take it from the top? What can you explained pre-call that you grew up in a real estate family. You made some money in your career, like most of our investors here with JWB, myself included, and then got into real estate. But you weren't originally going for single family homes, right? How did you first take the plunge into real estate?
Well, back in 2015, I think, a good friend of mine I live in Laguna Beach, California. So I was I was still in the technology industry. My wife had retired from technology, and we had started investing in a few years prior in UPS store franchises. And so we had a few stores that was all going really well. So I'm really starting to develop some cash flow, and I knew I needed to kind of accelerate our investments, kind of create hopefully a retirement portfolio. And growing up in real estate, I knew I wanted it to be in real estate for all the advantages that a lot of people already know about: cash flow, depreciation, appreciation, the whole thing. So a friend of mine was developing a self-storage facility on some property they owned out in Bloomington, California, nearby here in SoCal. So he went through that experience. He built it, became really successful with it. And then he decided, I need to kind of rinse and repeat. I need to do this more often. So his goal was 10 to 20 self-storage facilities. And he is an active developer, manager, the whole integrated vertical, kind of like JWB and self-storage.
Mm-hmm.
So he needed some investors to kind of scale. So myself, half a dozen other friends of his, we all started investing with Jim. He started buying more properties, and mostly existing facilities. And we never looked back. So it's been a really good asset class. I learned a lot about self-storage. I kind of grew up in kind of residential real estate. And so it was a learning experience for commercial for me. But as I learned, I really liked self-storage. And it was kind of, even back in 2015, was kind of not a well-kept secret, but not a lot of investors were in self-storage. There weren't yet a lot of syndications. There weren't a lot of ways to get involved unless you were active, unless you were buying and developing and managing it yourself. So it was a pretty small group of people, at least, especially in SoCal, that I built a network with through my friend Jim. And that was our plan. Our plan was we were going to do 1 to 2 a year for 5 to 10 years, and we're all gonna, be millionaires. It was all going to be great. Well, as the real estate market heated up, specifically in Southern California, but I think around the nation since 2015, we were finding it harder and harder to find really well-priced deals. More money's coming into the market. More savvy investors, even some hedge funds and really well-capitalized investor groups were coming in and really bidding up the prices. So as a kind of a small or medium tier investor group, we were having a hard time competing. So myself and the rest of the guys in the group started looking around. We've got money to invest. Where else can we go? So at that point, this was 2018, 2019, I started spending a lot of time on YouTube and following a lot of different real estate investment blogs and different people in the industry. And I found out about JWB through, I think it was the Get Rich Education podcast with Keith Weinhold. I think that was maybe late 2018. And Greg was a guest. I don't know if that was the first time, but he was a guest, and I guess Keith had been down and visited JWB, and I got the whole download on why. I think the topic then at that podcast was why single family rentals, why build to rent, why Jacksonville, and Greg did a really good job of just kind of laying the foundation for people interested to take a deeper dive. So, I started doing some due diligence about Jacksonville and various other markets and this whole build to rent, single family rental kind of business model. I think by then, Wall Street Journal maybe had done an article or something, and that kind of gave you guys some juice. But long story short, I convinced my wife, hey, we need to make a trip down to Jacksonville and check this out. In Jacksonville, let's go look at some other markets and see what we think about this whole thing. And we did. We came down in February of 2020. So that would have been right before, a couple months before COVID really started shutting things down. Met with, it was Mike Stetson at the time, Ashley Hatton, and a couple other people in the office, and had a really great meeting, set up some visits. We went and looked at some other JWB properties, both under construction and recently rented. He gave me some referrals, checked those out. At the same time, we went to some other markets. There were some other developers doing similar kinds of things in Orlando, Palm Coast, Ocala. So we spent a couple extra days kind of checking out the investment landscape, getting to know some of these neighborhoods. But we spent most of the time in Jacksonville, just driving around neighborhoods, kind of trying to get a feel for things. And a couple of months later, we had 2 houses under contract. And then it was pretty much 1 or 2 a month right after that, all through COVID, even up till I don't know when JWB started limiting the number of new properties, right? It was like you can only buy one at a time basically because supply was starting to dry up. All the effects of COVID were starting to hit the build side as
Mhm.
well, and demand was probably I'm guessing was at an all-time high for investor properties. So that kind of slowed us down a little bit. But to your point, yeah, my original plan was really just to kind of diversify out of self-storage and just get another asset class and kind of round things out. And so I thought 10 looked like a reasonable number, but things have been going really well. And I think my wife and I have decided now that we'll continue to stay in Jacksonville. We can talk more about some other markets. I look at other markets all the time because um, I I've always thought that I wouldn't want to just have all of my eggs in a single basket, and even in single family rental in a single neighborhood or a single market. I kind of like some level of diversification, and so I've been looking really hard at some other markets, both in Florida and out of Florida. But I'll be honest with you, I keep coming back to Jacksonville because the numbers are still work the best.
You said a lot there, Mark, that I want to dive into, man. That's a really, really good storyline and a really, really good basis. I kind of want to say, first of all, it's clear that the automated reminder for our weekly call did not go out. So I'm just super grateful that we still have 13 people that found their way here just because they love the show so much. So I'm just really, really grateful for all of you that came. I want to remind you all, which we didn't end up doing in the beginning because I was freaking out about the fact that there was no reminder, that this is a fan oriented show, right? So like we want you chatting in the chat like you're doing right now. We want you adding Q&A to some of Mark's questions here. If you have a question for Mark himself or anything that I can answer, we want you interacting. Do that in the Q&A. Mark, I guess the first thing that I hear in what you're saying is you kind of went into this already. You went into this with a passive mindset to start, right? Like it sounds like you were never really going to be an active investor. You were trying to be passive. And at the time, the storage facilities were a pretty passive investment. And then they started getting a little bit too active for you. So you started looking elsewhere. Is that kind of accurate?
Well, the reason that I decided initially to stay more as a passive investor initially was I wanted to make sure this was going to work. The real estate, I I was still working. I was working full time. I was traveling internationally. I didn't have a lot of time. My wife's running, 3 UPS stores and all the staffing and all of that stuff. So neither one of us had a lot of spare time. But I knew that as and at that point we were all, in our early mid 50s. I knew that the time horizon was we've got maybe a 10-year horizon here that we need to kind of start transitioning from what we're doing now to the next thing. And I don't ever really think I'm going to ever retire from something. I might retire from one career but move to another. So we had about 10 years, I thought, to put together a portfolio that at some stage, should we have more time, we'll have the option of being a more active investor, an active manager. We can manage our own properties if we want. But I started off looking for the easiest path to get started. And JWB just checked all the boxes for me because it's integrated. They find the property, they vet the neighborhoods, they look for the best return to the investor. They build that house, they manage it for you all in one, and they have a team around them. As any of us that know that, investing, the biggest thing is you got to find financing. You got to find a lender that you can work with if you're going to build a portfolio, not just one-offs, like when you get a home, buy a home, but something you can build a relationship with and, kind of streamline the process so you can move through a buy process faster. And JWB, great references for local lenders in Florida that know investors. Anybody that's tried to get an investor loan and you try to go to your regular bank or to your lender that owns your home mortgage, it usually ends in frustration because they don't know how, and I'm self-employed. So that's an extra hurdle, right?
Yeah.
And they don't know how to qualify you. Oh, you can't afford to buy this. I'm like, it's cash flowing. I make money on this transaction. So anyway, I just felt like the team that JWB had checked all the boxes. They was vertically integrated. They had a good lending network. They had the insurance, that know how to deal with investors. It saved me a lot of time to get started. So I felt like it was a good fit. And that I could still remain passive. Although this year, I actually checked the box to become as a full-time real estate professional. This is pretty much what I'm doing full-time now. My wife still is off on the UPS store um, um, uh, hamster wheel, if you will, and I'm just spending my time, finding, really primarily finding properties, closing deals, and then managing it on the back end. So I'm becoming more and more active, but not self-managing. I don't think that I think the things that JWB does as property manager, or any property manager, really, if they do a good job, they're adding enough value that it makes sense to, especially I'm in California. How am I going to property manage and chase tenants down in Florida? It just didn't make sense. So it's a good fit.
Yeah. Makes a lot of sense. That's cool that you're now the full-time real estate investor. I bet that now kind of opens up some stuff of being able to travel and whatever, and claim it as a business expense, right? Of like seeing the properties and things like that.
Yeah. The main advantage, and probably a lot of people already know this, is that you can, so you use all the depreciation that you might generate out of a property in year one. You don't have to, I think it's $25,000 as a passive investor. If you're a W-2 earner, you're limited to the amount of depreciation you can take every year. Whereas a real estate professional can, if they elect to, can use it all in 1 year. So because I'm still, a small business owner, and I'm successful, we've got multiple 4 stores now. The cash flow is sufficient. That's a pretty big tax hit, especially in California. So the depreciation as a real estate investor, for these 6 or 7 properties that I bought so far this year, I can depreciate all of those fully in the first year. So it's a big tax advantage. So that's part of the reason why I do it, but I also love it.
Yeah. Like you clearly love it. You got the cash flow is king poster in the background.
Yeah, that's rule number 1 right there.
Definitely fully bought into the investor mindset, right? I like that. Mark, before we all right, before we get into the property, I do want to ask you. You said that you looked at a bunch of other markets, right? Mm-hmm. And you evaluated different things. Can you kind of give us a breakdown of what is attractive in the Jacksonville market that keeps you there, and what you saw in other markets that may be attractive, but you learned something different and therefore you went to Jacksonville? Kind of like the stuff that you learned on the journey that made you settle in on Jacksonville.
Sure. Well, I'll use one example, and that's Orlando. Fast growing market. There's a ton of builders down there doing similar build to rent type product. And when we made our visit of February 2020, I thought at that time, we looked at a ton of properties, a lot of land in Orlando, and I'm like, God, you look at the statistics, you look at the demographics, right? And you look at, wow, Orlando is such a powerhouse with all the tourism and all the migration that's going there to support all of that tourism industry. And then that's building construction and medical. And, every city, if you go to their chamber of commerce, I'm on a chamber of commerce. I know the marketing that they spend to try to make their city look more attractive to a potential business than any other surrounding communities. So Orlando looked really interesting on the surface, but the more I dug into it, I'm like, it's not as diversified, the economy, as I would like. I had some concerns, and even in February, we weren't thinking about the pandemic too much. I mean, it was a topic, it was in the news, but we're like, yeah, whatever. It's not doom and gloom like it became a few months later. So I just saw so much undeveloped land in the Orlando area where these developers were building, just hundreds and hundreds of lots. And I'm like, there's just going to be a tremendous amount of competition. Yes, there's going to be a big supply, but I just got nervous about where the city was and where the development was relative to me as an investor. Long term, it would probably will be fine. But I'm number one focusing on cash flow, number one, right?
Mhm.
And then what's the appreciation in that market going to look like? What's my exit strategy or my refinance strategy 3, 5, 10 years down the road? And I just had some, I wasn't worried, but I was a little concerned about that, especially when I compared it to Jacksonville, because to me, Jacksonville, much more diversified. It's much more mature as a city. Deep port, right? I mean, there's you just go through the Chamber of Commerce talking points, and I just felt a lot more comfortable with where Jacksonville was and where the opportunities, particularly because in the case of JWB, they're doing mostly infill, where if you go to some of these other markets, they're all on the periphery. I mean, like Jacksonville would be, you're out by the airport or you're way west in new housing developments and tracks. That's where a lot of that build to rent inventory was going. And it just, I was like, man, I just don't see it. Where in Jacksonville, most of my properties have been, I don't think I have anything in Arlington, but a lot of the other areas are areas where JWB has been for a number of years, but they're three infill lots or 4 lots, and I just felt like the neighborhoods were more established, the demand for rent would be a lot more stable, a lot more predictable. And then long term, I felt like in established neighborhoods, it's going to be more stable as far as what the long term exit opportunities would be, whether it's appreciation or refinance those neighborhoods. You can go to that neighborhood today and see what it looks like, right? Yeah. Where some of these other markets you might go to in Florida or other states, and it's just vacant land, so you don't know what that neighborhood's going to develop into, good, bad, or not. Yeah. So Jacksonville continues for me to check all those boxes, but at the start, it's got to be cash flow. What's the business case look like when you look at one of the sheets you're going to put up? It's like, what do the numbers look like? That to me, that it starts there, and if the numbers all look acceptable for me and what I'm looking for, then I dig in a little further into the neighborhood. I'm more familiar with Jacksonville now, but when I wasn't, we go to a lot of online resources to look at the neighborhood and the schools and all of those things that make me feel comfortable that it's a desirable neighborhood for, in my case, families. If you can attract a family there because it's close to schools or it's good schools or they have sidewalks or whatever that your criteria happens to be, then I dig down. But I always start with the numbers.
That makes a lot of sense. As you were explaining all of this, right? You may or may not know this, but I grew up in Miami. I recently moved here about 3 years ago. I'm a Miami guy, and I remember, as I was telling you earlier, I went into the construction trade in the early 2000s when it was on, right? Like everything that you described was, building, new neighborhoods everywhere, and what you described to a T was, it was all at the edge of town. Like I remember driving down 8th Street and like the end of what I used to think was the end of Miami and seeing like 10 neighborhoods popping up. I'm like, who the hell is going to live here? Right, and just wondering about that. And now that you contextualize that, and I think of what JWB builds, where it's like you said, it's not this edge of town, brand new neighborhood from scratch that they're building. What they're doing is going into these neighborhoods that have a bunch of land and filling houses in between houses. I never thought of it that way because I didn't have an investor hat on, but I could see how that would make you way more comfortable, man. That's a really good point that I don't think anybody's brought up. I've never had that like insight, man. So really, really interesting. So
excuse me.
Yeah.
Well, the other thing is, I think Greg has talked about this many times is, they're how many years into this journey? A dozen, 15 years?
14, 15, 14. Yeah.
And from the beginning, they were buying lots and just land banking them. So they've got lots spread all over, where in a lot of these other markets, even developers that might want to compete with JWB in Jacksonville, excuse me, they don't have that land bank. They're newer. And so they don't have the options to do these infill lots the same as JWB does. They have to go to the outlying areas and build there because that's the only place they can get lots. And then you just layer on top of that all the issues with materials or labor or the planning permit, process. Pretty much every market that I've looked at in Florida and out of Florida, you're pretty much stuck right now to putting deposit down on a lot. A developer secured lots. You pick one, you put a deposit down, they build the house for you, and then 6 to 9 months later, permits and as long as the process can happen that fast, then you take title of a house and then you've got to rent it and all of this. Where the turnkey model, I don't think there are too many people that can compete with JWB in or out of Jacksonville right now. That's vertically integrated. They build the house, they're pre-marketing it. The day that we close on your property, I think, bar none for me, they've all been rented and cash flowing. And that's just not the model that a lot of developers, I think they would love to do that, but they're just not in a position like JWB because they land banked and they have enough scale now, they can't in that way can't compete.
Yeah, we talk about that a lot on the show, and it really the level of like business crush that I have on the business model acumen of JWB, of having had the foresight of the land banking and this moat that they've created around them, is really, really hard to imagine. The way that they operate, it's like, I'm like a business book nerd, right? Like I'm reading all this Jim Collins and all this other stuff, and it's like they operate, and I'm in the world of, I'm learning my marketing stuff and what I'm doing as a business from B2B Silicon Valley SaaS companies and like how they're operating. And I look at what JWB is doing, and it's like one-to-one the way that they're operating. And you just don't see that in a real estate company, man. I think it's really cool. But I want to get to, it's 1 o'clock. I want to get to the property because we're supposed to start with the numbers, like you said, right? So we're going to magically whisk us away here to 377 Duane Avenue. Let me get it up here and let me know in the chat that you can see it okay, and that I can zoom in around and make sure that everybody can see it all. 3377 Duane Avenue, Jacksonville, Florida 32218. It's a purchase price of $196,000, 3-bedroom, 2-bathroom house with a 2-car garage. Estimated rent range at around $1,250 a month. You see here, it is a new construction home that is a typical floor plan of what JWB has in their new construction homes. And this is what Mark is talking about, right? Rule number 1, cash flow. It's got an estimated conventional financing, total monthly cash flow of $114, and an estimated conventional financing total ROI of 7.38%. Mark, we always start here at this cash flow number, and you're just talking about that. Cash flow is rule number 1. When you see this cash flow number, what do you think of? What's your first opinion on that?
Well, I'd like it to be higher, but the reality is, and probably others have had a similar experience. If I look at the first 2 properties I bought in April and May a year ago, that number was $350, $400, and it was a combination of the interest rate and the purchase price was lower. So everything else, taxes, insurance, all of that is pretty comparable. So JWB is not immune. No developers immune to the inflation that has hit construction over the last 3 to 6 months specifically. So no matter where you go, cash flows is being impacted. So I'm having to readjust. And for me, I've already used all my Fannie Freddie subsidized loans. So, I've got two and a half, I think 275 was my lowest. And they're all between 275 and 3.25. But now I'm in non-qualified land, and now they're 4.25 to 4.5 unless you want to pay points. So that further, and I think JB, I don't know what the interest rate assumption is here, but it's probably, the last one I looked at was like 4.25 maybe.
4.13% is on this.
Yeah. So that's pretty realistic, I think. If you've got if you can do a qualified Fannie Freddie, you can probably do better than that without points, but otherwise that's realistic. So I'm not, that wouldn't deter me as long as I kind of draw my floor at about $100 a month for cash flow because I know that it's only going to go up over time, right? So, I'm every one of my bill, if I can start out at $300 or $400 a month and then grow that, $500 to $1,000 a year, $50 to $75 a month increase every year, with maybe some adjustments in there, you can't go wrong. So the total return is going to be solid. And again, this is just one thing. Cash flow is my starting point, but I'm going to look at the tax advantages of the depreciation, right? I'm going to look at the appreciation, and that, to me, that's the hardest part, but the biggest windfall. I think Greg has always talked about, don't buy these properties based on what you think it's going to be worth in 5 years. Don't count on appreciation above the normal, which I think, what is it, 3.5%, 4% in Jacksonville?
4.3% is the historical average.
Yeah. So if you just play those numbers in, but the reality is, I think 2/3 of the properties that I bought this year from JWB have all overappraised by $20,000 to $30,000. So when we closed, we had even more equity right away. So the market's, appreciating at a much higher rate, even in Jacksonville. Obviously, that's not sustainable, but that's like a bonus, right? This last year, if you're getting in now, and I think this trend would probably continue for the next 6 to 12 months, my crystal ball, that you're going to get a little bit of bonus appreciation that will continue to carry on. So what that's done for me is I'm looking at doing, cash out refis. Like what was the guy was the other day? Adam, is that his name?
Adam on Tuesday. Yeah.
Yeah. So he was talking about, you did a cash out refi example. So, I had not built that into any of my financial models because I looked at, maybe 10 years down the road doing a refi. I'm pulling that in now because as an investor with 25% down and you're already getting this last 2 years, some really good appreciation, that's going to accelerate the time frame in which I can do some refi. And if you have a big enough portfolio, 10 properties or more, probably, you might be able to do a roll-up loan and do a commercial. And for me, that's attractive. I don't know if Adam talked about that, but if you refinance, that cash out refinance as a loan, depending on how you structure it, that's tax-free income. So there's a lot of games you can do on the refi side. So that, to me, that's kind of a bonus now, irregardless of the cash flow. So to me, that kind of offsets a little bit the fact that the cash flow has been going down because it's costing more to build these houses. But at the same time, I know by looking at other markets, you're not locked. Most of the developers aren't locking you into a price. JWB, I know my price is going to be 196.
Yeah.
I'm signing up. I'm putting a deposit down, which could or could not be refundable, depends on the deal. And they can't tell me what the house is going to be, what it's going to cost when it's done, because there are huge increases in certain building materials, right? I think that's starting to taper off a little bit, but I think keeping the price, JWB's done a decent job of keeping the prices down compared to other areas and developers that I've seen. But to your original question, 114 is not super exciting, super sexy, but it's solid. It's still solid enough for me.
Yeah, man, that was a really, really good breakdown of cash flow, with the options of it, the way that appreciation affects things, the idea that it's only one part of the profit centers, right? Like we usually then go into this ROI calculation of 7.38%, talking about the fact that this includes the other profit centers. This includes the so first of all, if you're new on the call, that cash flow number, that is the typical monthly cash flow that you're going to have. That doesn't include one-time costs and different things that happen every so often as a rental property owner. This is your typical month. And that is what you're taking home afterwards, but it also doesn't include a bunch of benefits, right? So this calculation here does the ROI. This includes four of the five, I guess 3 of the 5 profit centers, right? If you're going to talk 5 profit centers being cash flow, tax shelter, debt pay down, appreciation, right, and hedge against inflation, this includes those first 3 and also includes the cost of closing costs. It includes tenant fees. It includes property management fees, maintenance, vacancy, all that stuff that's built into the life of it. But it doesn't include this appreciation number that, what just happened here? Okay. It doesn't include this appreciation number that Mark was just talking about, because when it comes to appreciation, like you just said, Mark, it can waver, right? Like it can go up and down. Right now it's super, super high, right? Like it's been about like 20% last year. JWB's come out and said that they're expecting like 10 to 12% appreciation in the short term. So it's going to be really high. But really what you want to look at, what we talk about a lot on the show, is you can count on the historical rate of appreciation happening as long as you're in for a full market cycle. And in Jacksonville, that's that 4.3 number we talked about. So if you include it, if you are going to stick in for a full market cycle and you include that appreciation rate, now we're looking at a completely different return portfolio here. Mark, you want to take a shot at explaining why this thing went from 7% to 23% when we put in the appreciation right there?
Oh, well, I mean, that's the value is just going to go significantly high. Well, you put appreciation of 4.3, right?
That's right.
Yeah, I mean, that's just a calculation based on what the future value of the house is going to be. And it's obviously it's been trending higher than that. And I would add the one thing that I look at, beyond just starting with the cash flow, as I mentioned earlier, you kind of dig into the neighborhoods. And I passed on a lot of properties early on. Mike Stetson was getting a little frustrated with me because he's like, dude, what's wrong? What's wrong with this one? What's wrong with this one? I'm like, yeah, I don't want that. I don't like that neighborhood. You guys are building 30 houses in that neighborhood. Yeah, but it's a great neighborhood. I'm like, I get it. So what I did, I looked for the kind of those outliers, those ones that it was onesie twosie. They only had a couple of lots in this neighborhood, and it had already gentrified to a significant amount. So part of the reason I think I got some maybe bonus value at close with the appraisals, where we were building homes. These homes were built in kind of a nicer what was becoming a nicer neighborhood, faster than some of the other markets or neighborhoods where JWB has a lot of lots. They're all good. They all cash flow. I just was being super, super picky on the beginning. I'm a little less picky now because I'm more comfortable with the process and everything as we go along. So I'm kind of branching out from that. But for instance, all my properties are 4-bedroom, 2-bath, 2-car garage, because I wanted that especially during COVID, people are moving from apartments into homes. They want that home office. They want that extra room. So for the cost differential of a 4th bedroom, I felt like that gave me a leg up in the neighborhoods that I bought in. Maybe they're all 3-2s. Okay, well, I'm looking to rent in this area. Oh, there's a 4-2. I'll pay $50 a month more or whatever. So we tend to get my properties tend to be on the high side of that neighborhood rent, which is just better cash flow for me. So I look at, I think every investor looks at things a little bit differently, fits their investing profile and what their needs are. I'm building a long-term portfolio, and I'm willing to spend a little bit more up front. I'm fortunate that I can to lock in what I consider be a better neighborhood or the best available neighborhood with the best available rents, and get a really solid starting point. So far it's worked out. Obviously I'm only a year or so into it, but hopefully I'll have another 10 properties, and if you guys will build them fast enough.
Yeah, you brought up something that a second ago, right? Like this idea that there was a limit on them for a little while, and that was caused by just this like glut of permits at the building department. And as we discussed on our warm-up call, that's now lifted, right? Like you can now buy multiple properties. But I find it really interesting, man. I've never heard that nuanced approach of the fewer houses that are being built and the more established neighborhood, and being able to pay that premium for adjusting for your risk tolerance is a really, really interesting approach that I don't think people have talked to, because we generally, and then you're also talking about what we do normally talk about. It's this idea that JWB sees all these homes as equal widgets, and
Right.
and to them it's, hey man, we're adjusting for this thing. We're adjusting for the risk of this thing and making sure that this thing's going to perform. And we believe in all of them, but it still allows you to maneuver within it. And as you maneuver within it, you're now starting to just like open up your perspective to the idea, like, oh, maybe it is okay to open up the net a little bit. That's cool.
Yeah. Well, I mean, I've started, you guys, it's not, this is the only thing that would be an advantage for me, is what's coming down the pipe. And I know that's not something that JWB likes to tell people in advance, is, oh, we're building in 90 days, I'm going to have this one or this one, because it's unpredictable, the building cycle. I get all of that. Why the reason's not, but I still prefer 422s, but there aren't a lot of 422s always being built, or they seem to pop up at just random times. The majority is 3.2. And, I like garages, but that's not necessarily a deal breaker, especially, I guess, in the Jacksonville market. A lot of carports and one-car garages seem to be more common.
Mm-hmm.
As the thing that, this is just kind of a weird thing that I just noticed, is no garbage disposals. I walk in, you walk in, it's like, well, where's no garbage disposal? What But then I got educated. It's like, well, because that's the number one maintenance complaint, is somebody plugs up a garbage disposal.
Mm-hmm.
So, by saving, not having one, you reduce your, long-term maintenance costs. And it made sense, but it's just one of those weird things. It's like, when you talk about how the houses are built and all the hard surfaces and built for rental and durability. And again, that's one of the reasons why I've stuck with the build to rent model, is they're brand new. They're built to code. So Florida hurricanes and bad weather and high winds, it's built to code. A 1960s house, I've already experienced this, has a lot higher insurance premium than a new build. So you save money right there. Plus, knock on wood, you shouldn't have any significant maintenance for 2, 3, 4, 5 years, as long as you've got reasonably good tenants that take good care of the property. So, you buy an existing, turnkey product. I have one of those from JWB as well. Haven't had any issues yet, but that's always, I keep a bigger mental reserve for maintenance and repairs, just because it's an older property. Even though it's been renovated, it's not a new house. So something could happen down the road. So, maybe I'll stop. I'm kind of rambling here. So
you're killing it, man. Like I love everything that you're saying, and I'm seeing it through your eyes as well. Me as a client of JWB's as well, I'm thinking about my homes, right? Like mine are existing homes, because I don't have the capital to buy new construction. And I know that I evaluated it as, okay, well, I'm getting in, it's going to be the same kind of, at the end of the day, I'm going to have the same ROI at the end of the day, but a new construction home is a little bit more expensive and has a little bit less maintenance costs, while a existing home is a little bit less expensive with a little bit more maintenance costs. Right. But at the end of the day, it's still looking for that ROI number. And I haven't had any issues with maintenance either, because everything gets, like you said, everything gets renovated or built to the same standard that is all made to reduce maintenance costs, be it no garbage disposal or hard flooring or everything else that JWB does, based on this like data flywheel of the 4,000 properties that they manage, and really just like testing out what reduces maintenance expenses and stuff like that, man. So I think that was really, really enlightening. Mark, you talked a little bit about the performance of your homes. I got a little surprise for you, man. Have you looked at this?
Oh, you're going to pull that up?
Is that all right?
Yeah, that's fine.
Yeah, just I just find it really interesting that you've been investing for 1.2 years, and you're already at 8.51% return without any kind of appreciation in the mix. Really nice, net rental income, total return lifetime, really, really good for 1 year. Is this, we mentioned at the beginning of the at the beginning of the show that you were originally thinking that you were going to have 10 properties.
Right.
And now you are thinking about expanding that pie. Is that based on the performance? Is that based on the market? You talk through us?
It's a combination of things, but if I go back and talk about my self-storage portfolio, it is so overperformed. We typically pro forma a refi, cash out refi in 5 to 7 years. We cash out refi both my properties, my initial properties, within 2 years. So I got two big checks, one 9 months ago and one about 4 months ago. And I got money burning a hole in my pocket, so to speak. So I need to go invest that money. Now, normally what we do is when we cash out refi, we go roll that into another deal, another self-storage deal in that case. But there's no storage deals. I'll be at investor conference later today. Hopefully we'll find one. But so I basically came into money that I didn't expect to have sooner. So I'm like, I need to put this money to work. And that kind of jump started more properties sooner. I'd already thought about things were going pretty well. I knew self-storage was going to be difficult to find the kind of properties we want in the next, hopefully things will get a little bit more reasonable, but in the next 6 to 12 months. So I already looked and I said, listen, the best we can do right now is to continue to buy single family. And twice a week, I'm looking at other markets. I have not found one single market that will outperform Jacksonville right now, in my opinion. So it's going to be JWB.
All right, we'll take it. So you're talking about, so you came across some liquidity. That's awesome. That's not a 1031 exchange. You cash out refi. So now you're looking, so you're not forced to invest in real estate. No. You are investing in real estate, and you decided that the best asset class in real estate is single family rental properties in Jacksonville because you like the market dynamics. Have you looked at other asset classes to put some of that money into? Have you thought about maybe going to the market or crypto or anything, gold or something?
Yeah. I talked to a lot of people. I watch a lot of YouTube videos, all the different investment strategies. And I always come back to, how many ways does real estate pay me? I'm building a portfolio for, the next phase of life, for income. So we're planning to exit our UPS store franchise in the next 2 to 3 to 4 years. So I'm trying to build a portfolio that's going to replace that income so that we don't have any lifestyle change whatsoever, maybe even increase cash flow. So to me, it's got to start with the cash flow, and that's where real estate pays me. It pays me in depreciation. It's paying me in appreciation. So it just fits what I'm doing. Would I experiment? My son, he's 25. He's experimenting with crypto. He's day trading Netflix and what was the AMC? All that stuff. I think that was the movie.
Real estate bets. That chat room. Yeah.
So he's bragging on how much money he made. I'm like, you wait till you do your taxes and you have to pay taxes on that. Yeah. What do you mean? I'm like, you sell it. So I just, the whole tax advantage for me exiting a franchise and having large lump sums come in, I need that depreciation, especially in California where I'm going to pay a boatload of taxes. I'm still going to pay taxes, but to really offset some of that, I can't find a asset class that's going to outperform down the road. Well, I have a lot of the guys that I invest with in self-storage are now in multifamily. That was their, diversification strategy, was buying apartment buildings in Anaheim, and they're in-state and out-of-state. And I passed on those deals because I don't control the asset. They're an investor. They're one of 100 investors in a big apartment complex. The idea, the process is the same. We're going to buy it. We're going to improve it. We're going to raise the rents. and then we're going to cash out refi, and then at some point we're going to sell the property. But none of those things are in the control of the investor. So single family, I have complete control. And they're like, well, yeah, but multifamily, I've got 300 doors. So if somebody doesn't pay the rent, it's not a big deal. It's not going to affect my cash flow. I'm like, if somebody doesn't rent your house, it goes from whatever, $250 a month to minus whatever your mortgage payment is, right? And I just don't see it. Yes, that's a risk, but I'm building a portfolio of hopefully 20 properties in the next year. Okay, so one guy's not paying his rent. I got 19 that are. It's the same concept, but getting started, I can agree that that's a little daunting if you just have one or two and you're really stretching your budget to get started in investing. If you have any hiccups in the rental process, yeah, it could hurt. It could hurt a little bit. So I just say build up some reserves that first year of income, put it in the bank, sit on it. Now you've got reserves, right? So if somebody doesn't pay their rent, or, in COVID, right? I didn't have that experience, but some people did where they had problem collecting. So, I just build up I'm fortunate enough that I can build up a reserve. So I don't really have a big concern about that. I don't think the market that we're in Jacksonville, the demand for, we go back to the demographics, right? You look at the net migration into Jacksonville is so solid. The economy's diversified. I don't see happening there. I said earlier about Orlando, when tourism got shut down, they got slammed pretty hard. And I'm in California trying to figure out what's going on in Orlando. You guys are much closer, but I think that if I had a 20 house portfolio in Orlando and the suburbs, and that was all driven by tourism and tourism related, I'd be a lot more nervous than I am right now. I don't lose any sleep at all about my JWB portfolio.
That's awesome, man. That's really cool. That's really, really well explained. Mark, you told me before the call, there was something at the end of this call, you had some advice to give.
Oh, okay. Well, so I was just going to highlight, these are probably things that most people on this call are familiar with, but these are some of the tools that I use when I'm evaluating a property, whether it's JWB or any market. Google Maps is your friend, right? So you can drill down to the neighborhood. You can drive up and down the street without physically being there and see what the neighborhood looks like. What your neighbors on both sides of your property, or how close you are to train tracks or to, an industrial area, all of that. So Google Maps for sure. And then, I use Zillow and Redfin. They're not perfect, but at least it gives you some idea as far as what rentals are in the neighborhood, in the market. And then I do that research, and then I back that up with JWB. I was like, what do you guys see? And the advantage of JWB is because you're in so many neighborhoods, and in some markets, so many homes in a neighborhood that I wouldn't say controls the rent, but have a big impact on what the neighborhood rent is, especially maybe in a neighborhood like Arlington. I mean, the rent is what JWB kind of sets the rent as. That's the bar, right? So I use all of that data to figure out what's my rent potential. We use Neighborhood Scout. That's another website. It's just a neighborhood ranking tool, and they talk about the schools, what they're rated, where is the school, so you can kind of, if you want to, map that out relative to your property to see how close you are to schools. Or how good the schools are, because that's an important criteria for me. Is the neighborhood family friendly? Is it safe? Right. So tools like that will help you figure that out. And what else did I say? There's a YouTube website, YouTuber. It's called Reventure Consulting. Mm-hmm. It's a guy that, maybe you're familiar with him, but he puts out YouTube videos once or twice a week now, and he analyzes a market, a real estate, a city. So you go on there. There's not one for Jacksonville yet, although I've asked him for Jacksonville. But he digs into all the demographic trends. He pulls data from a lot of different sources, and he really tries to put together a story on the, the good, the bad, and the ugly about a particular city. But he's also doing it nationally. He talks about how, is the real estate market going to crash? And he talks about all the demand for housing and but it's all data driven. So if you're kind of a data, geek like I am, it's really good information. I don't always agree with his conclusions, but the data is there, and he shows you where you can go get all of that data. They're apparently on Zillow. I haven't done this a lot. There's some tools in Zillow where you can download by zip code all kinds of rent and resale information, so you can go do your own analysis if you really want to go that deep. So just I just try to find those go-to tools. I also use the local board of realtors. So in Jacksonville, I pull up because they also publish their own kind of view of the market, and sometimes they do it by neighborhood, and you look at what values are, single family or condo, what the trends are. I think Greg actually might reference their data on months supply pretty regularly, and it's just crazy how low the month supply of inventory is in Jacksonville, even with all the construction. It's just there's nothing.
It's really low.
So I think that that also plays into why it's such a good market for rental right now, is because even people that moving to Jacksonville that might want to buy, it's hard to buy, maybe where they want to be anyway, or they've got to wait for that house to get built. So I think that plays to the strength of the business model that we're talking about. So those are the tools. I can talk about other resources for other markets if you want. I can tell you who I look at for other investment properties if you want me to. It's up to you.
We're running up on 1:30, man. So I want to be respectful of your time. But if you want to get into it, I've got time. Like, you're putting on this masterclass.
Yeah, I'll just mention them real quick. Yeah. And I think JWB is big enough and you have enough scale that you don't really probably, that I'm aware of, other than like Keith Weinhold and do some interviews, you don't really use some of these aggregators like Jason Hartman, right? So he's a kind of an aggregator, but he has developers and likes build to rent. He does that. He has developers in a lot of cities. So you can go to jasonhartman.com and put in your city, and there's both turnkey and new properties there. So he's in and out of markets wherever they cash flow. They do stuff like in Nashville or Memphis or Oklahoma City. That's not where I want to be, but some people that makes a lot of sense. And then the other one is the Real Wealth Network. It's the Kathy Fetke and Rich Fetke, I think. Anyway, they're similar aggregators, people all over the United States. Those are the two that I look at. One of the things that I did want to ask you, Pablo, because I was trying to remember, didn't Greg talk about JWB venturing into multifamily, like duplexes and fourplexes for new construction?
I don't believe that he has. I know that there's a couple things that they're doing, right? Like they do townhomes, right? So I know that they do townhomes, and
Right.
that can be, 2 to 4 unit townhomes in one building. Right. It's not technically multifamily, has a lot of the benefits of it, but less of the reason they don't do multifamily is because the multifamily that exists in Jacksonville does not fit their neighborhood criteria for safety. Right. So, it doesn't fit their neighborhood criteria, while there are townhomes where they fit their neighborhood criteria. So I know that's there.
The townhomes. Yeah.
Yeah. And I know that, they developed the container apartments in downtown, and they're doing a bunch of different things in the urban core, but that's them doing economic development. That's, a very small part of things that they do. That's part of their R&D and their future facing things that keep them vertically integrated and ensuring the housing supply and economic development of Jacksonville in order to really affect the market. But I'm not sure if fourplex is how you're describing it. I have not heard that.
Okay. I don't watch every week religiously. Yeah. Unfortunately, I'm pretty busy. So, but I would just add, if anybody out there wants to connect with me, either you have deals or you want to talk about deals, I'll just give you my email. It's mark at mgroupventures.net. That's my email. Just email me anything you want to, connect on. I'd be happy to. And, maybe there's some deals out there that, I'm looking, I'm open. You ask about asset classes. I'm not just solely focused on single family. It's working right now. So I'm going to keep riding that horse as long as it's working.
Yeah.
But I definitely, I still hope to do more self-storage deals. And, if there's triple net leases or something else out, particularly, I really like Jacksonville. Of all the cities that I've looked at, and I continue to look in the West, Tampa, St. Pete, that area. But compared to Jacksonville, I just don't see the value for rentals that I see in Jacksonville. So as long as that's the case, I'll hopefully be down in a few months, and we'll look you guys up.
Hope to meet up with you then, Mark. Listen, I'm gonna cut out this last piece that you just gave this wonderful tutorial on tools. We're gonna cut a little video out with it that has your call for deals at the end. That way you can use it to introduce yourself as like as a lead magnet, as they call it in the marketing circles that you and I have been. Mark, awesome. Before I let you go, man, I just, out of sheer selfish curiosity, because I know that you're super involved in the Chamber of Commerce of Laguna Beach. It's a place that I absolutely adore. If somebody hasn't been to Laguna Beach, like, it's maybe one of the prettiest places in America, along with where Jen Filson lives, the Monterey Peninsula. But what are your favorite spots? If you got a friend coming to Laguna Beach, where do you take them?
Well, I mean, we're a beach community, so you take them to the beaches. They're a little unique. You've been here. They're different than Florida beaches. They're all coves, right? So there's a lot of rock features and some interesting surfing if you like to surf or do water sports. We've got some great resorts here. We've got the Montage, the beautiful first-class experiences. There's Laguna is known as kind of a unique community. It's not really stuck in the 60s, but a lot of people think that it's stuck in the 60s. That we were. I guess there was a big music festival in the canyon back in the 60s that they called Woodstock West, I guess.
Yeah, I didn't know that.
So there's a lot of it. We're really art centric still to this day, but Pageant of the Masters, live art performances, tons of really quality artists live in and around and have galleries in Laguna. So it really still is an art mecca. It's been a great business for me, shipping art around the world. So there's some really unique art here. I just the weather. I'm a mountain biker, so I have hundreds and thousands of miles of mountain bike trails here. So there's hiking. There's a little bit of everything here, and the weather's always great.
It is wonderful, man. And that Pageant of the Masters is such a phenomenal experience, man. I remember going to that and just being completely blown away. If nobody's ever heard of it, real quick, go-to restaurant in Laguna Beach that you like, that's your date night spot.
I'd say right now, go to Harley's.
Harley's. All right.
Yeah. Greg Daniels, head chef. Really good. Really good.
That'll do, Mark. That's all I wanted, man. I want to take notes on that stuff. So next time I'm in town, I check it out. Maybe I'll look you up. I put two and two together. The genius of having a UPS store in Laguna Beach that just landed on me. That's real smart. And thanks a million for coming. And I want to, thank our community that made it, despite not having an invite, still having it on your calendar to show up and still getting 13 of our Not Your Average Investor Show family here on the call. I really, really appreciate you taking an hour out of your Thursday to hang out with Mark and I. I thought Mark delivered fantastic value, man. This was one of the more educational calls that we've had with a guest on. It's clear that you are a real estate professional these days. So really, really appreciate it. On Tuesday, we're going to go deep into the property management experience. We have a guest coming on that has many, many properties. He had a different property manager and just moved them all to JWB. So we're going to dive into the best practices for property management, why JWB is so passionate about the fact that you only buy the property one time, but the property management relationship is really what you need to have in place, that team that you need to have in place. So I think it's going to be really, really, really informative. I hope to see you all there. Mark, I'll give you last word to send us off here, man. I really appreciate your time.
Thanks for, putting up with me and listening to me ramble, but I learned so much through the process when I first connected with you guys through that Get Rich Education podcast. So I really got an education very quickly in single family and in Jacksonville. And that's the value you guys deliver to the investor community. So just keep up the good work.
Appreciate it, Mark. Have a good one, man.
Thank you.